The O Cannabis Conference and Expo returns to Toronto June 1st through the 3rd, and there's still some good booth locations available. This exciting event is free for cannabis retailers and will feature Tommy Chong receiving a Lifetime Achievement Award at the O Cannabis Industry Awards. For more information about exhibiting or to register to attend, go to ocannabis.com. That's OCANNABIZ.com.
Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your cannabis business podcast. Today, we're going to take a look at the stock market as well as some other indicators. We'll take a look at housing as well as pension funds, and of course, gold and silver, and what's happened in the overall economy. So let's jump right into it. What pandemic? We're seeing the S&P bounce right back from the 200-day moving average for the first time since early March. So is this a correction or a bear market? So corrections generally occur over a short period of time, not to break the prevailing trends in prices. They're quickly resolved by markets reversing to new highs versus a bear market. They tend to be a long-term affair where prices grind sideways or lower over several months as valuations are reverted. The valuations also suggest that the decline in March was a correction and not a bear market. This chart is showing the history of the secular bull market going back to 1871 using Dr. Robert Shiller for the Case-Shiller Index. And so they're looking at the bull markets being defined by expanding valuations while bear markets contract valuations. If March indeed was a correction, then the earnings will need to quickly recover back to the previous levels. However, given the economic devastation, it's suspected that the correction was likely the beginning of a more protracted valuation reversion process in the bear market. Well, Citibank says that the entire bear market rally since March has been driven by short coverings, meaning you've got short sellers, they have to cover their positions. And so they're buying those equities in order to close that position. And so there's a temporary spike, making it look like there's buying when in fact it's just short sellers closing their positions. So Citi analysts say 31% of global equity rally since March lows was probably driven by short covering. And there was $120 billion outflows at the same time. So as money is leaving, there's still a rally. So it's obviously people that are shorting and making that look like a dead cat bounce. So there's a technical indicator suggesting that there's a historic top forming at the moment. So in this chart, we look at the ratio of large cap tech stocks, which is the NASDAQ 100, and the broader tech market, the NASDAQ composite, on a monthly basis. The large cap concentrate NASDAQ 100 has been the clear leader for several years versus the NASDAQ composite. But that theme appears to be sending a concerning signal to the market. So as you can see from the chart, the tech ratio peaked in 2000 and a prolonged bear market followed. Earlier this year, that ratio retested the 2000 peak while recording back-to-back monthly bearish reversals in March and April. So this raises concerns about a potential double top. Not everybody's shorting the market. The Swiss National Bank is going to buy a lot more tech stocks than they already have. The Swiss National Bank U.S. equity holdings increased more than threefold from 26.7 billion in December 2014 to 97.5 billion in December 2019, almost $100 billion. They just print money and buy equities. So according to the Swiss National Bank's 13F filing as of March 31st, the central bank owned 4.5 billion of Microsoft, 4.4 billion of Apple, 3.2 billion of Amazon, and 2.7 billion of Google, 1.6 billion of Facebook. So the largest concentrations of tech stocks in the S&P 500 are all these companies, and they're driving the market. They're driving the perception of the economy. They're definitely driving this index. And it's all from central banks just printing money out and then buying these equities. What happens when they sell it? Who has billions of dollars to recover those losses? When they sell, who's the buyer? Trick question. It's just going to be other central banks buying. There's central banks buying 2.4 billion in assets every hour as their balance sheets eclipse $20 trillion. In the past 8 weeks, central banks have been buying $2.4 billion per hour of financial assets. As the feds print trillions of dollars, we have 40 million people unemployed, and yet the NASDAQ is up 35%. At some point, we've got to ask, is losing nearly 420 jobs for every death worth it? Wall Street would like to think so. The U.S. equity markets are roaring higher as if it never happened. So the U.S. federal balance sheet raised above $7 trillion for the first time, and now they're going to be buying bond ETFs or exchange-traded funds at $1.8 billion worth. I find bailing out any ETF or exchange-traded fund kind of worthless. Is not a real company. It's just an index, and you're bailing out debt. Bonds are debt, and anyone who bought that is a investor or speculator. Why? I don't get it. So here's a list of the some of the ETFs that the Fed has revealed that they've bought so far. One of those is Hertz that filed bankruptcy. So they've got bonds from a bankrupt company. I don't know if they're going to go out and actually just repo cars, what they think they're going to do with that. Not all bonds are created equal, though. You can actually take junk bonds and make them into investable grade securities. So there's an article here about how Wall Street can convert a portfolio of 96% junk loans into 87% investment grade bonds. I'm not going to get into the details, but I'm just telling you the government has no idea what they're buying. So last week's initial claims hit 40 million, continuing to be the highest level ever recorded. This is the worst unemployment spike in history. 1 in 4 American workers has filed for unemployment benefits in 2020. According to a current U.S. Census Bureau, the U.S. economy is now in a death spiral. Nearly half of Americans say that their incomes have either declined or they live with an adult who has lost pay. We're already starting to see mortgage delinquencies rise to very alarming levels. And with last week's 2.1 million people filing for unemployment, that's almost twice as many Americans so far total that have filed for unemployment than jobs gained during the entire last decade since the end of the Great Recession. So with all of the uncertainty, job losses, decrease in disposable income, you're seeing pending home sales plummet 35% year over year. That's the biggest drop ever as buyers are forfeiting deposits. The Northeast fell 14.5%, Midwest fell 22%, the South fell 19.5%, and the West fell 26.8%. Currently, we have the lowest level of pending home sales since records began in 2001. So here comes the wave of loan defaults hitting a 6-year high. 2 weeks ago, we were looking at a flurry of Chapter 11 filings with a striking correlation between the unemployment rate and loan delinquencies. Now we have a biblical wave of bankruptcies that is about to flood the U.S. So it's not just individuals that are having financial difficulty. You're also seeing some states that are having some serious financial woes. So with Illinois being potentially insolvent, they may have to tap into the Fed's emergency muni facility. So Illinois is caught up in a little contango. They're paying 6.5% in a 10-year bond. That's 5 times higher than the average. Right now, you can get a rate at 1.1% to borrow. That's effectively making Illinois paying the highest nation's borrowing rates by far. The difference in funding rates merely reflects Illinois' collapsing finances of unfunded pensions, soaring budget deficits, and unpaid bills. Many of Illinois' pension funds are less than 50% funded, and the state has mounting unpaid bills, currently standing at $7.5 billion. And it's not just Illinois. We've talked about California and other states too. California's in trouble. They have 340,000 public employees with a 6-figure paycheck costing taxpayers $45 billion. With individuals and states and the federal government teetering on bankruptcy, there are asset managers that are sparking concerns about the possibility of the collapse of the dollar. When the collective outlook fears generalized asset price deflation and zero may look like a pretty good place to hold your wealth, then you may want to think about gold. There's a relentless rise in gold and Bitcoin since the March lows. It might suggest that the storing wealth, even in modestly negative yielding perpetuity, has also looked increasingly attractive to many, including other sovereign wealth funds, governments, central banks. So why were central banks diversifying into and repatriating gold prior to the global lockdown? So the global economy was flashing danger signs long before the pandemic. For one thing, many of the countries were clamoring to get a hold of as much gold as possible. For the past decade, they've been buying new reserves, bringing it home from overseas storage to an extent never seen before. And then just before the pandemic, there was a pause. Central banks added 650 tons to their reserves in 2019, the second highest shift in 50 years after the 656 tons added in 2018. Before the 2007-2009 financial crisis, central banks were net sellers of gold worldwide for decades. Leading the recent spree has been China, Russia, Turkey, Kazakhstan, and Uzbekistan. And we've also seen a large effort by central banks to repatriate their gold from other countries, mostly from storage in New York and London. All of this asking the questions, is this a path to a monetary collapse for the US dollar? So as this crisis unfolds, the gold price is likely to be the most reliable indicator. And for this reason, gold prices rising sharply is not going to be welcomed by the majority of central banks, who will fear it as an indicator of declining confidence in their monetary policy. It's not just governments and central banks and sovereign wealth funds, but global investors are also demanding gold as a protection against the financial repression. Taking a look at the gold to silver ratio, suddenly silver looks extremely cheap. And historically, in a gold bull market, both precious metals rise, but silver rises faster than gold. So silver shines, even though in the last 2 months we've seen silver dramatically underperform gold. Interesting, though, it's tracking the US dollar index. The surge in silver began around the same time as the gold market broke, with this crisis causing the geographic shortages of the physical commodity. You can see from this graph as the prices shot up to about 3x. So as prices were about $20 for an ounce of silver, the physical price was closer to $60. And Bloomberg notes that the New York gold market has been flipped on its head in just a couple of months, with the scramble for the metal turning into a glut. All in all, we're still seeing that the price of gold is relatively cheap compared to the current money supply. And the price of silver is ridiculously cheap compared to gold. But if you want to get it, you got to get it while you can, because it's either going to be too expensive or it's going to be illegal. So they could make stashing gold illegal again. At some point, the authorities may attempt to demonetize gold, making it illegal to own as a private individual. That happened in the U.S. in 1933. And of course, right after the U.S. government did that, they reset the price from, I think, $20 an ounce to $40. So anybody who handed in their gold literally lost double the potential price appreciation. Unfortunately, not enough Americans even question the morality of taxation, let alone confiscation of their morally acquired property. And if that happens, you can bet that all hell could break loose. So invest wisely. With that, we're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't. And I'm out.
Hello, hemp friends. This is your host, Morris, from Volume Up, the Let's Talk Hemp podcast, where we explore and discuss all things hemp all the time. From industrial to nutritional to therapeutic to lifestyle, hemp has a place and a home pretty much everywhere. Download episodes now of the Let's Talk Hemp podcast wherever you listen to podcasts. Come get loud with me on Volume Up as we take industrial hemp to a whole new level in 2022 and beyond.